Greetings, everyone. Jerry B here. Welcome to the last cumulative class for our November educational series. We talked about a lot of things from class 101, 202, 303, and now for class 420, we're going to be putting together everything that we've learned and built upon cumulatively throughout our time in November. So without further ado, I just want to start off by saying thank you. 1,000 tongues would not be enough to express my gratitude for you all coming to these sessions. And, I look forward to wrapping things up and hopefully providing some value. So for today's class, we're going to be talking about 4 key objectives. We're going to begin by wrapping things up with our cause and effect from Wyckoff, using the price cycle as a general overview about how to use the Moribozu candles, the imbalance, as a means to guiding our risk to reward for the upside as well as the downside. I'll then dive into a multi-time frame analysis to give you guys a simplified approach as to what I'm looking for in the markets when I'm looking at the 4-hour, 1 hour, and then dialing in and refining the entries on the 15 and 5-minute supply and demand zones. And then last but not least, we'll conclude with some key points from the 25-point mantra by Douglas Zaleski on how to transcend fear and greed in the market. Because as we know, the market is always random and we're constantly learning as traders. We're constantly growing and transcending the things that cause us to not follow our plans and our setups, right? So how do you set yourself up for success to be able to transcend fear and greed and consistently rake in those profitable small gains, as well as let the runners run for those larger gains? All right. And then last but not least, I'll make some time at the end of the session to answer any questions that you all may have with regards to classes 1, 2, 3, or 4 for an interactive question and answer. So please save all questions and concerns towards the end of the session. But without further ado, let's go ahead and dive straight into the cause and effect within our price cycle. All right. So a quick review. Mr. Wyckoff, Richard Wyckoff, was a titan of his time for technical analysis. And his whole point or premise with the Wyckoff price cycle is that retail traders should follow the order flow within the markets, right? Meaning buy low, sell high, supply and demand, right? Super simple. Let's do a quick review on what that concept means and what that looks like. So hypothetically speaking, let's say we're in a downtrend, right? Within this downtrend market structure, we're going to have a premium, and we're going to have our discount. Okay. Let's say institutions are setting a supply zone at this premium level of $100. Okay. This is going to be recognized as our distribution zone, right? We talked a lot about this in class 303. So if you want to go back and get the nitty gritty and more refined details, please check out class number 303. But this is going to be recognized as our distribution zone, okay? This is where orders are going to be accumulated before the next step, which is going to be our markdown. Our markdown is an expansive move or retracement into our discounted levels to some previous or old accumulation or demand zone, all right? So this discount zone is going to be recognized as our demand, all right? Orders are going to be accumulated in this area before having a markup to, let's call this 99, right? Price gets distributed around 100. We have our markdown to, let's say, $98. Orders are accumulating or consolidating within this $98 range, and it gets marked right back up to 99. So the reason or cause for this move back up to 99 is because there was some imbalance left behind from that initial markdown into our previous discount or previous demand zone. Okay. The way that you can see this in the charts is by looking at Moribozu candles. Your Moribozu candlesticks are going to be candles that have little to no upper or lower wick. Moribozu in Japanese represents shaved head, right? So when you're looking for these Moribozu candles, you're looking for your supply zone, which is going to be the first green move before an aggressive sell-off into some discounted area, okay? Once you see that aggressive sell-off, or candles with little to no upper or lower wick, we want to look for fair value gaps, imbalances, gaps within the candlestick's wicks, all right? We talked about this in depth in class 101, more specifically, Japanese candlesticks. So I recommend that class if you want to learn more about the candles. But nonetheless, whenever you see that Moribozu candle selling off from some higher time frame supply, we have our reason for price to come back up into that area if we're going in an uptrend or downtrend. So price drops off after getting those orders distributed in some supply zone. Let's call this H4 supply, into some discounted area. Price accumulates or consolidates, aka choppy price action, once again before having a markup, which is our phase 3. Mark up back to 100 before having another mark back down to put in another lower low towards 98, 97 if we're in a downtrend. Vice versa if we're in an uptrend. So the cause is orders are being distributed at some demand zone. People are buying low to drive price back to some fair value gap, inefficiency, imbalance, so on and so forth. Okay, let's take a look at a quick example on TradingView. So if we take a look at the 15-minute time frame, we can see here that this area is consolidation. We see clear choppy price action. Price doesn't really know where it wants to go, but as we can see over time, price breaks towards the downside to fill in some imbalance. All right. Now, in the present moment, we can see here there's more choppy price action within this range. Price is trading from demand up into supply, up and down, up and down, up and down, choppy price action. But eventually we're going to have a break towards the upside. Why? Because there was a initial imbalance caused by this Moribozu candlestick here at our key psychological level of 400, right? So on the higher time frame, let's take a look at the 4-hour. We can see here that the trend is bullish. We are in a uptrend, bullish trending channel. Buy low, sell high, whatever you want to do. Price gives us a nice expansive move to the upside. It gets exhausted. And now we have a sell-off into some demand zone, some higher time frame demand zone. In class number 1, we spoke about the spinning top, and we have a clear spinning top here, which would be recognized as my quote unquote 4-hour demand. All right. Now let's go back to the 15-minute. Once price taps into this 4-hour demand zone, we get a nice reaction indicating that buyers are still interested in continuing this uptrend, okay? We have a consolidation period here. We have volume more volume here. Now, the reason for price returning back to 400 is to fill in the imbalance that was left behind after price gave us a clear confirmation that it wanted to continue higher on the higher time frames. All right. Now it's all about finding out, okay, what is the best risk to reward whenever we're modeling that entry to take price back up to the upside. So for calls, I was monitoring SPY on the 30-minute time frame, and I was waiting for a Moribozu candlestick. The Moribozu candlestick is a candle that leaves behind some inefficiency. So price came into that 4-hour demand zone, which is this gray box here. 4-hour demand zone, spinning top. The spinning top candle indicates indecision. Once price tapped into that 4-hour demand, I noticed that there was a Moribozu candle here on the 1 hour. This Moribozu candlestick indicates that price still wants to continue higher. But whenever we're looking at the risk to reward models, which we talked about in class 202, you want to see price come back down into that consolidation area or 50% mark of the Moribozu candlestick before continuing higher, right? Remember, institutions need liquidity. They need liquidity in order to move the market, all right? So in the example, we had our 4-hour break in structure towards the upside. We're looking for price to sweep some engineered sell side liquidity, but continue to hold the order flow before looking for price to continue higher, okay? And target some previously left behind stop losses. In classes 303, we talked about liquidity in more depth. So in this example, we have double top liquidity, right? But let's go back to the 4-hour. On the 4-hour time frame, we can see here that we have a clear break in structure, break in higher time frame structure. We have stops here. Or you could just say resistance. We have resistance here in this area. 1 touch, 2 touch, a little bit of consolidation with some double top liquidity up here, okay? Price breaks through this area of resistance, sweeps this liquidity, and puts in a new high, closes above, right? Closes above. So this is what I'm recognizing as my break in structure. This may also be discerned as a retest of our bullish uptrend. We have test 1, test 2, test 3, right? Now we're waiting for price to return back to a discounted area before the next leg higher. We have our 4-hour demand zone, area of consolidation, which indicates indecision. And we're looking for equilibrium, the 50% mark of that area of consolidation. And we recognize that area of consolidation as our 4-hour spinning top here, okay? So price taps into the 50% mitigation of the zone, not directly. Why? Because we have volume towards the upside, another Moribozu candlestick. So price comes in a little bit lower, takes out this low, and then we get our reaction, right? Price action isn't going to give you the exact same thing in the model every single time. So that's why it's good to understand your candles and how to read them within structure. All right, so once price taps into that 4-hour zone, we get a nice reaction. Now what I did was I went back to the 1 hour. We can see here that we have another Moribozu indicating strength towards the upside, which is the cause of this move. And the effect is going to be to fill in this imbalance from the previous supply zone. Okay. Remember, supply is going to be the first green candle before an aggressive impulse candle towards the downside. So an easy way that you can recognize what's happening here is just look for long body candles and look for the origin of those candlesticks. As we can see here, we have our first red candle before an aggressive impulse move towards the upside. Retail traders do not have enough buying power to be able to cause this move. So this gives us a clear indication that there's some smart money activity happening within this 390.8, 388.9 range. All right. And we're just looking for price to return to the origin of that move, sweep some sell side liquidity, and then target an imbalance towards the upside. All right. So in this case, for today's price action, I noticed on Monday that we had a Moribozu candlestick, and I'm waiting for price to return to the imbalance left behind from that Moribozu candlestick to target this buy side liquidity, right? And as we can see here, we have a nice hammer, which when we go to the lower time frame is just going to be a break and retest of structure. We have our breakout, retest of structure to confirm, and then we can just model our risks accordingly to target an imbalance left behind from some higher time frame move, right? Which was our 1 hour supply zone. Once again, supply is our first green candle before an aggressive push towards the downside. Let's take a look at one more example very briefly. I traded Shopify. Well, this trade is still in play as of right now. Let's take a look at the 30-minute. All right, so on the daily for Shopify, I noticed that price was forming a hammer. The hammer indicates strength or momentum towards the upside at some 50% mitigation of this Moribozu, right? That is a very ugly arrow. Let's clean that up a bit. I noticed this Moribozu here. Price is currently in an uptrend. I waited for price to come down to the 50% mark of this Moribozu and to show some type of strength. The confirmation was this hammer that started forming after sweeping this sell side liquidity or double bottoms, right? Once again, if you want to learn more about liquidity, check out class 303. It was key objective number 2. We can see our same model happening here. We're looking for our break in structure towards the upside, looking for liquidity to get engineered within the internal structure, and we're looking for it to return back to our origin of the initial move that caused that break in structure. So here we have our break in structure towards the upside within our upwards trending channel. We can see here on the higher time frame, we have a double bottom here, sell side liquidity, which got taken out. Why? to fill in some imbalance left behind from this Moribozu candlestick. Now we have a nice reaction, which is this daily hammer. Now, once we go to the 4-hour, what do we see? We see a spinning top, which indicates indecision. So what I did was connect the lower wick from this long red candle, which was intended to fill in some inefficiency within this Moribozu candle. I connected the lower wick from that candle, sell side liquidity, and the lower wick from this spinning top here, which indicates indecision. Let's drop down to the 1-hour. Now in the 1-hour, what do we see here? We see the sell side liquidity get taken out. However, we're creating higher highs. Actually, we're creating higher lows and developing a trend line, right? Which indicates that price wants to continue higher. Why? To possibly fill in some imbalance that was left behind between 35.5, 36. We can also confirm that this 35.5 is a strong level for the upside momentum by looking at the higher time frames. If we go to the monthly, we can see that that is the monthly open, right? 35.37. So if price breaks and holds that key level, we could see that imbalance get filled. There's also it's also a doji here, which closed above last month's candle. So there's strong buy side interest for this ticker at the moment. So we have our higher time frame bias. Now when we go to the 15-minute, all I'm looking for is a Moribozu candlestick. And for those imbalances to get taken out. So we have a Moribozu candle that's formed after these sell side liquidity stops get taken out. Buyers step in, price retraces back to fill in the imbalance. We have another Moribozu candle. Buyers step in, price retrace back to fill in the imbalance. All right. Now, this is my clear indication that price wants to continue higher, but this isn't enough to get in the trade actually. I'm looking for price to close above this area of consolidation, right? On the 15-minute, we can see here that we have our sell side. On the 15-minute, we have our first green candle before an aggressive sell-off. So confirmation would be a closure above this area of consolidation. Since price closed above this area of consolidation, now I'm looking for price to return back to 35, 35.2, show strength, and now we're targeting the imbalances that was left behind on the 1 hour, right? Within this internal structure. So for tomorrow, I'm looking for 35, 35.2 bounce. If it doesn't hold, then we can take puts under 34.86 to target low of day. So I just have my alert set at 35 and 35.2. If the reaction is strong, I'll size up. If the reaction isn't, I'll size down and look for puts. All right, so that's going to be our review for cause and effect within the price cycles, as well as our multi-time frame analysis. Next up, we have fear versus greed. Fear versus greed. So I've been trading for about 2.5, 3 years, going on 4. I don't have all of the answers. However, throughout my time, I have made every single mistake in the book, and I hope to just pour into you all so that you all don't make the same mistakes. And over my time, if I were to go back and give myself advice, I would say focus on teamwork, leadership, communication, and problem solving. Why? Whenever you're trading, it's very important to pull from those who you look up to. You see, Rippy Guy is one of the mentors that I look up to heavily. Aristotle, Brett, Kevin, all of them. I've learned something. I've taken a piece from every single one of them, and it has cultivated me and given me the drive, the discipline, and the focus to be able to continue to grow within this industry. Because to be quite frankly, there isn't a self-made trader that hasn't taken losses. So I encourage you to find someone or three, at least three mentors that you can look up to. It's almost like you're baking a cake. Okay. You have your icing, which would be, let's say, Rippy. You have your sprinkles, which would be Jarvis. And you have your eggs, which would be Reality. Okay. Take a piece from what each one of them are doing because they all trade differently. But in the end, you've got to remember that you're building this cake within yourself because it's always a you versus you situation, right? So, for example, Rippy sets stops on every single trade. So that might be one rule that you might have in your book as far as transcending greed. Set a stop loss. So if price, goes against you, boom, you're taken out and you don't, lose more than what's expected. Reality, size is small, right? So in that case, that might help you overcome fear, right? So if you have, let's say, $5,000 port and you're trading 0.5, 0.8 contracts, if it goes to zero, you're still okay with holding and sizing up later. Why? Because you're sizing with less than 3% or 1% of your account, right? So that will help with fear. That's the eggs within your cake. Jarvis focuses on dark pool levels. You might set a rule and say, hey, I'm only going to trade whenever price gives me a strong reaction at the 4 hour or the daily dark pool key levels. Now, this requires patience and discipline. Okay. This will be the sprinkles within your cake that you're building. Now, each one of these key components are what's going to be the driving force as far as helping you overcome the fear and the greed, right? Under the lens of teamwork. Next up, you have leadership. Now, whenever I think of leadership, I think of this little kids movie where it was like these little, what was it, like little balloon like characters running around this little girl's mind, controlling her consciousness. Okay. Now, let's say you have 5 rules that you know you need to be doing, but you have to be the leader of those 5 rules that are running in your mind. You see, in trading, it's you versus you. So by being a strong leader within yourself, what does that look like? Every day, you need to be journaling and writing out and planning like you're the hero in your own story. What is my stop loss? What is my entry? What is my exit? Right? How much am I risking per trade? If I have, let's say, a $5,000 port, does it make sense for me to get 5 contracts at 1.0 or 3.0 fills out the gate? No, not really. You might want to look for smaller contracts like 0.5s or 0.8s and then slowly build a position into that. So, for example, the leadership might say, okay, if I don't have my plan set up in the morning, then I'm just not going to trade. That's the discipline and the internal communication that we need to have in order to be able to transcend fear and greed and not to drive ourselves crazy and lose insurmountable amounts of money like I have in the past, right? Next up, communication. Communication leads me into my next point, which is journaling. Journaling is very, very significant because in trading, like I said before, it's always you versus you. Literally, it's you versus you. If you journal every single mistake that you've made and figure out, okay, I'm going to FIO, figure it out. What am I doing wrong over and over and over again? And how can I build in systematic plans? How can I solve this internal problem within myself to be able to yield different results? Does that mean, do I need to study more? Does that mean, do I need to simplify my plan? Does that mean, do I need to wait for a liquidity sweep and then model a risk to reward for the opposite direction? Does that mean, size for zero, wait, see how price reacts, and then, react to what the market is doing? That's going to vary from person to person, which leads me to the last point, problem solving. In trading, no trade is going to ever be the same. No trade is ever the same. There's going to be points where you get caught in choppy price action and consolidation. And to solve that problem, just wait for an outside break. Set alerts, walk away. Sometimes you might only take 2 to 3 trades a week, but that's okay because you understand, okay, price is within this cycle of consolidation. And I only want to trade expansive moves to the upside towards an imbalance or an expansive retracement to a downside imbalance. So the safest way to overcome fear is to just wait for that outside closure, which is what we have here on SPY on the 1 hour. And then model your risk to reward from there. Otherwise, you might risk, getting chopped up or caught in consolidation, which is what we don't want. Now, if you're a swing trader, you might take reality's style of trading, size very, very small, wait through the consolidation. If it breaks out, size up, in and out, take your profits, walk away. If it breaks to the downside, cool, the initial trade probably lost, but now you're prepared to take that downside movement if price invalidates your internal structure, right? Which is what we have here. So for problem solving, just know that you're constantly solving problems within yourself. So I can encourage you all to journal. There's a useful link or a journal in the Discord that Jarvis posted last month. I highly recommend you all check that out. It's right here. Yeah, trade journal, right? How do you feel? Daily goals, trade details, and notes, right? But all I would encourage you all to add is your entry, exit. Oh, he has it. He has everything here. Entry, exit, stop loss, details, and notes. How do you feel? And then in the notes, I would just write what's going right, what's going wrong. If you do this consistently over time, you start to see patterns within your trading, and then you can cultivate your own strategy to be able to transcend fear and greed. Because the way I trade, the way Jarvis trades, Rippy, reality, everyone's different, right? And you kind of just have to find your own niche. And that only comes from getting in the market, taking those hits, journaling, okay, why did I get knocked down? How do I build myself back up? And taking a more systematic approach to, building that over time. Which leads me into the last point, which is the 25-point mantra by Douglas. Yikes, pardon me, getting tongue twisted here. Which leads me to the last point, which is the 25-point mantra by Douglas Zaleski. I'm not going to point out any, trading rules because I think the 25 mantra does a phenomenal job of talking about everything, every rule that you could make in the book with trading. So if you're interested, I highly recommend you all check out that resource. But for the sake of time, we're going to go over the first 10. So if you Google 25-point mantra, discipline for day trading, these rules are going to pop up. And I think this will be a great resource to help you kind of understand the mistakes that may come up, the challenges that you might face throughout your trading journeys. So first things first, the market pays you to be disciplined, which leads me to the point of leadership. In trading, you are the leader of your trading business. If you have 5 rules, you got to be able to communicate within yourself, okay, these are my 5 rules. I'm going to journal, set up my risk to reward, R multiple, looking for 1 to 2, 1 to 3. If price breaks below my R multiple, I'm cutting, I'm walking away, taking a break, and I'll come back later, look for confirmation. It's on to the next one. Step 2, be disciplined every day and in every trade, and the market will reward you. But don't claim to be disciplined if you're not 100% of the time, which reinforces what I just said. If you have a risk to reward set, make sure you cut it, right? If your risk to reward is working for you, it's okay to size up and let your runners run to target some type of imbalance, all right? Step 3, which is my favorite, always lower your trade size when you're trading poorly. Me personally, I go into every trade assuming that it's going to be a loss. So I automatically size very, very small, which is a rule that I got from reality. I love the way he trades because he only sizes less than 1.0 or zero point 0.8 on the trades, right? So if it goes to zero, you're fine. But if it goes up and breaks through, he's looking at the higher time frame structure, you could size up and make, substantial profits by just analyzing the market slowly, almost like you're swing trading. So initially, always trade small and you can size up later. But if you're scalping, you might want to size up big, have a firm stop loss, and then go from there. But like I said, it varies from person to person. Number 4, never turn a winner into a loser, right? So this is very important. And I don't see a lot of options or derivative traders use this tool, which is going to be the predictive measurements. So if you go into trading view, click on the pencil, scroll all the way down to long position or short position. And this tool will help you visually see your R multiple, right? So in this case, for the upside, we're using the long position. I already entered this trade. That's why my long position is down here at 35.10. But if I were to size up, my R would be 35.2 bounce. If price shows me a strong reaction, once it comes down to 35.2, my stop loss would be 35. And I'm targeting the imbalance that was left behind on the 1 hour. 36 for price target 2, or 35.68 for price target 1. But since I'm swinging, I'll target 36. So in this case, we have a 1 to 3 on my size up. But on the initial position, it's a 1 to 10. Right? So understanding where to cut, where to size up, things of that nature is a great way to transcend fear and understand how to never turn a winner into a loser. Okay, so price comes down, I'll just cut, break even, or small, -5, -7%, and then just look for, either a break to the upside to get back in or a break to the downside to change the bias. Step 6, your biggest loser can't exceed your biggest winner, right? Which ties back into the R multiple. So each trade should at least be a 1 to 2, 1 to 3, or higher, right? So that way, over time, you're either doubling your money or taking small gains or small losses. Stage 6, which is develop a methodology and stick with it. Don't change methodologies from day to day. This brings me back to my communication. So in trading, you're going to be doing a lot of internal communication, talking to yourself, saying, okay, this trade didn't work out, that trade didn't work out. I wasn't really feeling too good. I had some personal issues going on. And over time, after journaling and synthesizing all of that data, you'll start to see patterns, right? And this is going to be your development of your personal methodology because, to be quite frank, trading is going to vary from person to person, right? My strategy, the way I deal with risk, is going to be totally different from how you all deal with risk, and so on and so forth. But the best way to really dial in and cultivate a methodology is to get in, take those losses, take those wins, and understand why price is doing what it's doing, why you're making the same decisions over and over and over again. Is it impatience? Is it greed? Is it lack of discipline? Right? Journaling is going to help with that. So step 6 is definitely my favorite on the 25-point mantra, because without that methodology, without that plan, cultivating and extrapolating consistent profits is going to be extremely difficult over time. So if you're new and you're starting out, consider developing that methodology early on in your journey. That's something that I wish I would have done within my first year. And step 7, don't be yourself. I'm sorry, be yourself. Try not to, be someone else. And that's just gonna come with developing that methodology and slowly learning yourself, right? Slowly learning what's working, what's not working, and what strategy works best for you. See, me personally, I like to trade a lot slower. I trade maybe one to three trades a week, right? Constantly just watching, waiting for price to meet my entry and exit model, looking for price to sweep liquidity from the downside, show strength at some higher time frame zone, and then follow up to target some imbalance that's left behind, right? These are my entry models, and I stick to them. I'm looking for price to return back to some old fair value gap, to expand back down, to put in another lower low. As we can see here, price is targeting this fair value gap, returning back to old supply. So my risk to reward would be to target this piece of liquidity to put in another lower low. Of course, it's going to take a lot of time for that to happen, but I'm more confident in taking the trade by just waiting for the setup to come to me, right? But that might be different for you. You might want to take it to the upside and the downside, if you're scalping, but you've got to be prepared for the blows that might come with that trading style. Similar situation here with Shopify. I got that breaking structure towards the upside. I saw price sweep liquidity towards the downside, start to show strength and get prepared to put in another higher high to target this liquidity here. Price comes in to our higher time frame zone, consolidates a bit, gives us a closure outside of the range, and I'm targeting this buy side liquidity. Why? To fill in this imbalance. So step 7, be yourself, try not to be someone else. Step 6, develop your own methodology and stick to it, right? And that's just going to come with time, journaling, and being a leader of your own steps with trading. 8, 9, and 10, you always want to be able to come back and play the next day, right? Which is kind of repetitive to steps 1 through 3, which is 1 through 4, which is never to turn a winner into a loser. So never turn your winners into a loser. Step 8, you always want to be able to come back and play the next day. If you're on a losing streak, understand your max drawdown, right? Which is going to be communicating within yourself in your journal. Okay, what's my max drawdown? What's my stop loss? What's my entry? What's my exit? If you focus on the downside, the upside will take care of the rest. Literally, focus on how much can I lose on this trade as opposed to how much can I make, and the upside will just take care of itself. Trim 20%, trim 50, trim 100%. You get in with one contract, it goes down, takes your stop loss out. All right, cool, boom, done with that trade. We're on to the next. You get in with one contract, let's say it works out in your favor, you're up 20%. Now you might size up with 8, 50%, maybe 70, or even 100%. Once you're up 50 or 70%, take off 7, leave 2 contracts running, right? So you always want to be able to come back the next day and manage your risk and understand where you're entering, where you're exiting. Which leads me to the next point. Earn the right to trade bigger. Earn the right to trade bigger. What does that mean? I'm going to tell you all a quick story. I've mentored hundreds, if not thousands, of individuals, and I've noticed a similar pattern. They get a strategy going, they get a methodology going, myself included. One trade, 100%. The second trade, 250%. The third trade, home run, 700%. Now in the fourth trade, we get encouraged to want to size heavier, right? Which is a recipe for disaster. You size heavier, it's going down, boom, you think it's going to turn back around, goes down even more. Now you're down 30%, 40%, 50%. Sorry, I lost my train of thought. you're going down 30, 40, 50%. And now you just lost touch of your rules because you have this overconfidence, right? This overzealous confidence within your strategy, which is where you just lost touch of your trading plan. So when it comes to earning the right to trade bigger, after every win, forget about it. Pretend like it never even happened. Every new day is a fresh slate. Every new day is a fresh slate. If you're only getting 20% and the price is showing weakness and it's going against you, cut immediately. It's got to be robotic, systematic, like an algo, right? And over time, if you can prove to yourself, right, like you're the leader, giving yourself these you're communicating to yourself as the leader of your ship, your trading rules. Once you prove to yourself over time, then you can size up, right? But if you're constantly being overconfident, sizing up too early, um, and letting the trades go red, you don't deserve the right to size bigger. Does that make sense? So slowly but surely, build the discipline, the humility to know, okay, I got 3 big trades in a row, right? The 4th trade might be a loser. And if it's a loser, cool, I'm going to cut. If I size up heavy, I definitely got to cut. So just knowing and being mindful of your strategy and your rules over time is a great way to earn the right to trade bigger, right? Which confirms number 10, get out of your losers. If your trade is working against you, just cut immediately, because the worst thing you want to do is set yourself up to not be able to come back and play the next day. All right. So this is the 25-point mantra, discipline for day trading. I use this as the main framework for all of my students, for myself. Whenever I'm having a bad day or even a good day, I read it just to reinforce the idea that I'm the master of my ship. I'm the commander of my trading business, right? It's you versus you, right? If I'm not disciplined, if I'm not having a good day, I need to take a step back. If I'm feeling confident, I went to the gym, hit 225 for a 3x3, I'm following my trading plan. Cool. Let me take the trade today, right? So it's all about understanding your 4 key components, which is teamwork, find 3 mentors, and pick something from each one of them that resonates with you, right? Leadership, understand that you are the captain of your trading business. Communicate with yourself your trading rules. You can use 25-point mantra as a framework to kind of guide that and see what that looks like over time. And then step 4, constantly and persistently strive to become better, because trading is constant problem solving. You're constantly battling with yourself internally. Anything could pop up in life and affect your trading, but it's up to you to understand, okay, I'm not feeling too great today. I'm going to take the day off. Or, okay, I'm feeling wonderful today. Let me trade, but not get too confident. Let me respect my R multiple, knowing when to cut losers, let runners run, so on and so forth. So I'm going to conclude the fear versus greed portion with that. Hopefully you all gained some value. I'm going to now open it up for some interactive question and answer. So if you all have any questions, feel free to type in the chat or give me a holler. Of course, it's my pleasure, Virginia. So I have another question. If you all don't have any questions about today's class, please give me some feedback on how you all are liking the educational webinars. Is there anything that you all would like to see moving forward? Maybe live analysis, more in-depth talks about structure, supply and demand, any key topics. It could be anything. Controlling anxiety after finish early in the morning. Very informative. Enjoyed the 25-point mantra breakdown with personal insights. Okay. My pleasure, my pleasure. Controlling anxiety after finish early in the morning. Is that a question, or is that something that, or a topic that you would like to see moving forward? Mr. Y. Pino. Lots of knowledge. Okay, so would you all say, um, would it be better to kind of have smaller, more short breakdowns of the key topics instead of like an hour-long webinar? Maybe we could do 10 to 15 minutes or 5 to 10 minute breakdown. Would that be easier to digest the information? Structure, time frame analysis, entry and exits for future key topics would be great. Thank you again. Looking forward to future lessons. Thank you, Mr. V World, for showing up. Using the market replay function in TradingView to show your thought process as price is unfolding and what time frames you're looking at while going through the data. 1 hour is good for me. Perfect. Okay. Sounds like a lot of people are interested in um, what is it? Price action analysis. Would live price action analysis be something that you all are interested in? Live price action analysis and market replay. Okay, I'll definitely take note of that. Awesome. This is good information. Thank you. All right, structure, time frame analysis, entry and exits for future key topics. If you have any other ideas, feel free to just drop them in the chat. I'm taking some notes so we can synthesize some data and know how to improve these educational sessions moving forward. Scanners, ooh, my favorite. Scanners, equity discovery. Tape reading. Okay. So the 1 hour sessions are good for everyone. No need to break them down into um, smaller webinars. 1 hour is good. Perfect. Yeah, I try not to make them too long because I remember being in class, nodding off, falling asleep. in those 2-hour lectures. It's not fun by any means. All right, 1 hour is good. Awesome. Would you all be interested in intraday analysis? Intraday analysis, or like intraday price action, like, I don't know, intraday replay, or just live price action? Yeah, I think that would be very helpful going ongoing, since we broke down a lot of stuff for analyzing the market structures, candlesticks, and how to transcend fear and greed. So I think moving forward, that live price action could bring everything together after reviewing, the first 4 classes. Okay. Cool. All right, we have 5 more minutes. So if you all have any questions based upon the content that we talked about, whether it's candlesticks, um, transcending fear and greed, multiple time frame analysis, my favorite color, it could be anything. Let me know. If not, I can go ahead and conclude the session in 5 1,000, 4 1,000, 3 1,000, 2 1,000, and 1 1,000. Awesome, awesome. So I'm going to assume there are no more questions. I'd like to thank you all once again for your undivided attention. I'm going to take the feedback from the chat, synthesize the data, and relay it to the higher management so we can see how we can improve these sessions moving forward. But that is all for now. I hope you all have a wonderful Thanksgiving break, and I'll see y'all in the next one. Take care, everyone. Have a blessed night.